All right, we're going to go ahead and get started. So, what I'm going to talk to you guys all about a little bit today is index mutual funds versus the strength of a mutual dividend paying whole life insurance policy, otherwise known as IBC. And the goal is to give you some information out there about index mutual funds, as well as to show you what had happened if you had put that money into a life insurance policy, and then also show you one option of actually using your 401k to actually fund a policy and what that actually looks like. So just so you know, it is going to be recorded. We are going to be sending it out for you as well. So you guys don't need to record something. If you really want anything, my email, holly@livingwealth.com, is down at the bottom. Most of anything we share with you, we are more than happy to send out to you as well. What you guys are going to learn today, hopefully, is who are the 4 major mutual index fund companies and why do they actually benefit from your money? We're going to answer the question, what should be the primary goal of your assets as you near retirement or are in retirement? And we're going to compare a life insurance policy to a 401k plan and see which one was actually stronger long term. And at the very end, I'll give you some information about things you can do with your 401k right now due to COVID-19. Okay, there's 4 major players in the index mutual fund arena. BlackRock is the biggest. Vanguard is next. You have State Street and Fidelity. Those are the 4 main players. And BlackRock is the main one because it's the largest, but don't doubt that any of these 4 players are really controlling a lot of what you see going on, because most of them all have a share or major shares as well in our banks. BlackRock, troubling signs you might want to consider. BlackRock is the world's largest asset manager. In the U.S., not worldwide, they are worldwide, but in the U.S. alone at the end of the 4th quarter in 2019, they had $7 trillion in assets, okay? They are known as the world's largest shadow bank, which means they're not considered a bank, yet they are dealing with $7.4 trillion in the U.S. Most of those are our 401k. Vanguard has $5.3 trillion in assets. State Street has $2.5 trillion, and Fidelity has $2.46 trillion. Okay, but their total combined number of assets, like Fidelity, that they actually work with yearly is $6.7 trillion. So just under management is their 401k, but they're working with customer assets of $6.7 trillion. Now, why is this a troubling sign? Because in our last financial crisis, okay, our index mutual funds lost on average negative 30% of their value. So imagine 7.4 trillion, 6.7 trillion, 30% of that money being gone. And what does that say for your 401ks? Because they are the largest main funding source for retirement plans such as 401ks. Okay. Our banks have been blamed for causing the financial crisis of 2008 and 2009. Yet, we have major owners of our banks are BlackRock, State Street, Fidelity, and Vanguard. State Street, by the way, is the second oldest continually operating U.S. bank, okay? So they actually are not just an asset manager in regards to your 401k and index. They are actually own the second oldest operating bank in the U.S., okay? One of the other troubling signs is that most of us, and this is answering the question I said, what should be the goal of your assets in retirement, is you want to protect your principal, okay? Indexing doesn't protect your principal at all. In fact, that is what fluctuates, and there are no guarantees with it. So remember, your 401k is a retirement vehicle or plan, yet they don't provide any guarantees. It's just the illusion of a guarantee or your money's safe. So I would have you guys ask yourself, how much have you lost just since the beginning of March in your actual retirement? Or what have you lost in the last 3 weeks or month? Okay. The other thing you guys need to realize is they are a business. Okay. Where we would hope that we would save money because we don't have a financial planner telling us what to do and we're not paying all these fees associated with it because of our 401k. Yet, instead of paying fees, we also are helping businesses like BlackRock, and Vanguard run. And just so you know, they, according to Sachs research from 2015 and 16, so I know it's a few years ago, but BlackRock and Vanguard vote for increased compensation 96% of the time in pay packages, and State Street was 84%. Okay? What that means is instead of safeguarding and protecting your money in principal, they are paying out millions of dollars to their CEOs, CFOs, and individuals in compensation packages, okay? And Wells Fargo, in case we all have heard of them, you guys are aware that in 2016, they were discovered to have created 2 million bogus accounts. Those bogus accounts actually helped make more money for the managers, okay? And Wells Fargo kind of said, oops, and they got rid of the CEO, John Stump, but he was given, just so you guys realize, to walk away, he was given $47 million in options, okay? His net worth in 2020 is $55 million. And he actually, in 2012, before 2016 hit, his actual base salary was only $2.8 million. Yet in that year alone, he made, in compensation pay packages, he made $22.87 million. Okay. So he could afford to create bogus accounts and have them go, oops. But the reason I say oops is, why are we talking about Wells Fargo? Because the major shareholders of the Wells Fargo Bank is BlackRock, State Street, and Vanguard. Okay? The people controlling your money in the 401k actually own the majority shares of Wells Fargo Bank. Now, I'm going to give you some numbers just so you can see, and they're up on the screen when we talk about a 401k. Some of us will be in the middle of what we are saving or putting in. But actually, the average American puts in roughly $8,800 annually into a 401k. Okay. It's not huge amount, but it is a good amount of money that they're putting in. Okay. That's roughly $700 a month. Okay. Now, when we think about that, we have to think, if that's what you guys are putting in, if I put in $8,800 in 2010, that same $8,800, okay, would have to be $10,472 in the year 2020, because a dollar is always stronger today than it is in the future, okay? So 10 years ago, if you would have put your 8,800 in, that same 8,800, you would have to put in 10,472 to have the same amount of money, okay? Dollar for dollar. Now, the reason that's important is, if all we're saving is $700 a month, and that's the average, and we're saving less or we're saving more, then as you lose money, then you have to even put more money in to get back to where you were. And so what I did is take it in 10-year increments. So 20 years ago, if you'd put in $8,800, that money that had sat within the 401k, because it sits for a period of time, you can't access it without penalty, okay? As it sits in there, basically in 2020, it's got to be $13,437. Now, 1990, 30 years ago, okay? $8,800 is the equivalent of $17,933 today. So when we think, hey, I only lost a couple $1,000, I only lost this, look at how long you had been putting that money into the 401k or your retirement program and realize you gave them strong dollars, and in exchange you're getting weak dollars. And do you even have the $17,000 you maybe put in 30 years ago? Do you have $17,000 in your 401k? Last is $8,800 in 1985, 35 years ago, would have $21,000, okay? You will never regain the money you leave sitting somewhere if we keep doing the same thing over and over again. If we just keep putting money into our retirement program or 401k and we just keep hoping for a different result, we can see from 2008 to 2009, 10 years later, we have almost the same thing happening, only now it's due to a pandemic, but still money was lost even in 2019, okay? So what we want to do is try and change our thinking and our mindset. And I want to show you what that means actually with your 401k when you just leave money sitting there and it's of no benefit to you, okay? And before I do that, I want you guys to answer 3 questions, and I'm going to give you the answer after you have a pause or moment, okay? Do you guys believe are taxes going to go up or down, okay? In your lifetime, have you seen them gone up or down? And the reality is we tend to do a 401k or a Roth IRA or a retirement program or some type of retirement because we get a tax break, okay? And what we really believe is that we're saving on taxes. So we're going to put more money into the 401k to pay less taxes. Yet sometimes even that extra $2,000, you might have only had to pay $500 in taxes. Yet you give $2,000 away to save $500. And the reality is, in a 401k, it is not a tax saving, it is tax deferred, okay? So taxes are going to be paid on the growth of the policy, and they're going to be paid in the future. So are taxes going up or down? The reality is, and if we look at history, they are going to continue to go up. So you are not necessarily going to be in a lower tax bracket when you get to finally access this 401k money. And chances are you are going to be in a higher tax bracket paying more money. Now, is a dollar worth more today or in the future? Remember the previous slide, I just showed you that it is obviously worth more today than it is in the future. We looked over a 35-year time frame. The same $8,800 equals a lot more. So a dollar is worth more today than in the future. So you are giving money to your retirement programs today in exchange for weak dollars in the future. And do you want to pay taxes on the seed or the harvest? So your $8,800, you might be putting in $700 a month or $300 a month, whatever that may be, into your 401k. You are not paying tax on the, let's say, $8,800 you put in. You are paying tax on that money in the future, as well as any growth that it occurred over time. And you are not allowed to use it without penalty. So as much as you are saving it, you are giving away your strong dollars in exchange for weak dollars. And by doing that, you actually have to generate more growth in order to be able to live on more. So what does it mean to pay taxes on the seed or the harvest? It means it's the growth of the money. So not only are you going to pay it on the principal because it's tax deferred, but you're going to pay it on any growth. Now, most of us might not have had much growth due to what's happened, but we're going to have some growth eventually that we do pay taxes on. Now, you can see up here what I've done is talk to you. I want to talk to you about what happens with uninterrupted compounding, because what is happening in your 401k is that your money is growing depending on how it is invested. Okay. Now, the same thing could be said of a life insurance policy, only with the life insurance policy, you have compound interest taking place that is uninterrupted. So what I did is took 1 penny today, and if we had started doubling that penny on the 1st of March, then by the end of March, by doubling it a day, which is 100% compounding each day, we would have ended up with $10 million at the very end of March. Now, how is that possible? It's just uninterrupted compounding at 100%. Now, nowhere are they compounding 100%, okay? But even 4% or 5% or 3%, uninterrupted compounding day after day, year after year, will dramatically change your lifestyle. And what I'm going to show you exactly what happens if you have uninterrupted compounding that takes place. So if at day 22, you had decided you needed $20,971.52 to use, okay? And let's say you had borrowed it out of you took it out of your bank account and they were giving you compounding, right? You would have reset it because your bank account would have gone to zero. So you would have had to start by saving 1 penny again, then 2 pennies, then we got 4 pennies, then 8. And the end of the month, you'd only have $2.56, okay? Because we stopped compounding, okay? We stopped the growth of the money. We stopped it from doubling every day. Now, if we had used a life insurance policy and borrowed out this $20,000, the money would have still been compounding. And we still would have ended up with this $10,000 at the end of it, $10 million at the end of the month, because we never stopped our dollar from compounding. We never stopped the money from going in motion. Right now in your 401k, we are stopping the movement of the money. You're taking your strong dollars, you're giving it away, and you're letting somebody else do something with it in the hopes that it will yield a return. But what you're doing is you're not letting your money grow. How about if you can let your money grow and you can still use it? And that's the power of life insurance. Now, why am I talking about whole life insurance? Number one, you have uninterrupted compounding, okay? You have guaranteed tax-free growth. With the plans we design and you get to create, you are a shareholder. Right now, with BlackRock, Vanguard, State Street, Fidelity, you are not a shareholder in those companies. In fact, you are just a customer hoping they do something really good with your money. With a life insurance policy, with a mutual company, you become a shareholder. Therefore, the insurance company is working for you. And I wish that BlackRock and State Street and Fidelity and Vanguard would be working for you. I wish that they really understood the power of they have your money in their hands to provide for their future. but they are a business and they are out to benefit their shareholders. You're not a shareholder, so whether your money goes up or down, they're not so concerned as long as they still have money coming in, and they do. Okay. The other reason we're looking at whole life insurance is because you're going to keep your money in motion. You're going to be able to use it as well as be able to plan for the future and have a death benefit. That's the second point, okay? Your death benefit passes tax-free and is protected most of the time. That's for another conversation, another webinar, or another one-on-one, because it depends on what state you're listening in from. But your death benefit passes tax-free. With your retirement programs and 401ks and stuff, they've gotten really, really strict on who it passes to, how much time the individuals that possibly inherit this retirement money have to spend it. Normally, it's a 10-year time frame that it has to be used, and they can pay tax each year, but they're taxed. Your loved ones are taxed on that money. So one way or the other, the government's going to get their taxes on the money you are putting into those retirement programs. You don't have to wait to use your cash. Many of us have maybe worked 10, 15, maybe it's 5 years, maybe it's 20 years into our retirement program, yet we don't have access to our cash without penalty, except for COVID-19 now allows you to avoid that 10% penalty fee. But have you ever thought about the fact that it was your money that you put into this 401k program, and yet you don't have access to use it unless you pay a penalty of 10%? And you can get cash today and build a legacy for the future. So that's the death benefit. Now, most of us today, we need cash to live on. Tomorrow, we need cash to live on. And even 10 years and 20 years from now, we're going to need cash to live on. But the death benefit is a bonus because you not only get cash, but you get death benefit. So what does this actually look like? I'm going to go and show you a policy illustration, okay? And the reason I picked a 22-year-old male is because the example I'm going to show of using a 401k is with a 57-year-old male. And this individual had actually started working for his company at age 20, but he hadn't started putting money into his 401k until he was a few years in. Just didn't know, but he said he did it because everybody else was doing it, okay? So just because everybody else is doing 401k, maybe ask yourself if there's other options out there, if there's better benefits. And a lot of you guys do it as well because you get 401k match from your company. But let me just say, if the company is matching you, that's more money you get to pay tax on. It's not the company paying the tax on that. You get to pay the tax on that match and the growth of that match. Now, the individual is going to put $750 a month into his life insurance policy. Just remember, traditionally, when we set up life insurance policies, you're not going to pay that for a long period of time, but he is going to pay $750 a month over the next 35 years, okay? And typically, he would only do that until he's 27 years of age, and then his premium would drop to $350 a month. But I wanted to compare apples to apples if you had been able to do this, okay? Now, if he had done that in his 401k over 35 years, he should have roughly $308,000 to be able to access and use, okay? Now, at 57, he still can't access and use that without penalty, okay? And he actually only has available to borrow the maximum, no matter what was in his account, he can only borrow $50,000 out. That was his company's 401k, but he can only borrow $50,000 out, and that's what he's going to do. Now, I took this from a life insurance company illustration, and I just want to explain some pieces before we get through it. But this is the year right here. So this is the very first year. He applied when he was 22, but at the end of one whole year, he's going to have turned 23. Okay. His contract premium is $9,000. That's $750 a month times 12. Okay. And he has a guaranteed death benefit, guaranteed cash in the first year, $4,119. That's money he can use without penalty. Okay. Now, here's the thing. His money, his premium, that $9,000, think of it not as a payment. It is a premium deposit, but think of it as a deposit. We are depositing into our own savings account, but this way it's going to be a life insurance policy, not just somewhere at a bank, and it's not going to be a 401k. Now, if he had done this on the non-guaranteed side, just to let you know, he's got a total cash value of $4,654. Okay. And his death benefit is $606,000. Okay. Just rounding for purpose sake. Now, how quickly can he borrow $50,000 out? Okay. Well, on a guaranteed side, he can borrow $50,000 out right at year 8. Okay. Now he has access to all that cash. In his 401k, he doesn't have access to that cash. Okay. He hasn't even been able to borrow out all that he put in. He can only borrow out a portion. Now, on the non-guaranteed side, it takes only 7 years before he can borrow out $50,000. Okay. But he could have borrowed money out each year that he put his money in. He can borrow it out, but it's still the entire $9,000 growing uninterrupted compounding. I'm going back to that uninterrupted compounding, because as he takes the money out, he can pay it back as well. But how quickly does he get to $308,000 of cash? Okay. With our 401k, we said he'd put $308,000 in over 35 years. So right here is 35 years. Okay. And in his policy, if he'd done the same thing, he actually has $438,000 of guaranteed cash. He has 715 of non-guaranteed. Okay. But we'll go with a guaranteed. That's saying the life insurance company only made the guaranteed interest rate. And this is tax-free. So his money's tax-free growing right now. But he actually had $308,000 right here when he was 51. He would have passed it. Now, on the non-guaranteed side, by 45 years of age, he would have had $317,000 of cash to use. Okay? Now, I don't know about you guys, but even if I had been doing $750 a month and I'm 57 years old, $438,000 looks really, really good. And the fact that I can take it out by borrowing it and using it, and this is all tax-free growth. And even if I took the $438,000 out, that entire $438,000 that I borrowed from the life insurance company in my actual policy is still growing with uninterrupted compounding. It never left my actual policy. And should something happen to me and I haven't taken any money out, I still pass $1.2 million to my family tax-free. Now, that to me is a big deal. They don't have to pay for it or use it within 10 years. It comes to them and it goes to my loved ones, and it is protected. Okay. And what I mean by protected is even if you'd had debts and loans, in regards to any type of bankruptcy, they can't come after it. and other people typically cannot come out of after your death benefit. Okay. Now that's just the 22-year-old. And this was yesterday, right, that I ran this illustration. But imagine he'd had this policy in 1985. He had started this policy. It would be even better today, irregardless of the downturn of 2008 and 2009. And even what's happening today, the one peace of mind I have is my majority of my principal and my assets for retirement are in life insurance. And I'm not really worried about what the stock market's doing because it's not tied to that at all. Now, what does this look like if we actually had $50,000 we could use from our 401k? We don't have to pay the 10% penalty because of COVID-19 right now. And I chose to borrow the money and pay it back, okay? And your taxes can actually be spread out on this money if you withdrew it over the next 3 years. So there's borrowing it and withdrawing it. But we're going to borrow it, and we're going to start a life insurance policy for a 57-year-old male. And I'm going to show you how we did that so you can understand what was actually happening to him, okay? Now, this is the money he had available to borrow out, and he was 57 years of age, okay? Now, he borrows out the entire $50,000 because if you borrow the money from your 401k, you cannot take any more money out until the original loan is replaced, typically, okay? Now, he's going to take the entire 50 out because he's going to use it to pay for his policy premium, okay? His funds he has is $50,000, and he actually chose to take that money and he put it into a savings account tied to his policy, okay? So it went to his policy, it's associated with it, and it's his money. It's not available for other people to take or use. It's his money. When he needs it, he can use it. Of the $50,000, he is going to start a $20,000 policy premium, okay? Now, it's not a payment. Remember, it's a premium deposit. He's depositing into his own life, okay? Now, I'm going to just say this. The 22-year-old at $9,000 a year, $750 a month, had roughly $600,000 of death benefit. This individual is 35 years older. He's putting a little bit more money in, but his death benefit is still right over $500,000. Now, if he put the $750 a month into his 401k, he'd only have $308,000, of which that's if it just stays the same. There's no losses, there's no gains, but he still hasn't paid tax on that money, okay? And he hasn't paid any fees or anything like that, but it's going to have gone up and down, right? So we don't actually know how much cash he has, but what we do know is that he doesn't have $500,000 of death benefit to pass to his family, okay? And that's just historically looking at what the actual rate of return is with the stock market and 401ks over the last 20 years. You're not even going to get a guaranteed rate of 4% or 5% or 6%. They haven't performed that well. And Nate did a great webinar 2 weeks ago regarding exactly the stock market and looking at those numbers. So we got $50,000. He uses $20,000 to pay his policy premium, so his premium deposit, okay? And he's got $30,000 left over, okay? He has a loan payment of $11,600, okay? That is his 401k is charging him 6% interest for the use of the $50,000. He has to pay $966.64 per month. Okay, and we just rounded up. It's roughly $11,600 annually. Okay. At the end of the first year, his loan balance goes from $50,000 to $41,000. That's what he's repaid. Okay. And we see that he's freed up $750 a month. That is because the $966 is coming out of his paycheck. Okay. And the reason we say he's freed that up is because, remember, $11,600. Okay. $750 a month is the $9,000. Okay. But his loan repayment's $11,600. So what he does is he takes a policy loan of $2,600 because he was contributing $750 a month to his 401k. Now, he would be short because of the $11,600 he needs. So he takes $2,600 out, he puts it in his bank account so that should they need this difference of the money, he has it. Now, here's the kicker. He still has $7,939 to use that year. Okay? For whatever he wants. He can use it. Can take it out as a loan from his policy. And his interest for his loan is $130 because all he took was $2,600 the first year. Okay? Now, the second year, he goes ahead and he takes $20,000 of it out from his $30,000, leaves him $10,000, and he pays the same thing. He does another loan of $2,600, okay? And now his interest goes up to $260, okay? But he now has $16,000 to use that's available should he want to borrow it from his policy. Now, remind you, he's borrowed out only $5,200, okay? That's what he's borrowed out from his policy, okay? He's put in $40,000, but he has $40,000 growing, okay? So it's not that it's $40,000 minus the $5,200 from his policy loan. He has $40,000 of cash growing. Now, this is even the second year. Most of you, even if you put in $40,000 into your 401k in the first 2 years, you still don't have $16,000 you can even use, okay? And the next thing we're going to look at is he's only got $10,000 available now to pay his policy premium, okay? So he takes $10,000 from there, and now he's going to take a $10,000 loan from his policy of this $16,000, okay, plus another $2,600, okay? So his total loan is $12,600, okay? And his loan balance is $17,800 roughly, okay? Yet he's got $23,000 of cash to use. So he just gave the life insurance company $20,000. He borrowed out $12,600, and he still can use $23,000. He just made some money. He gave him 20, and they said he can borrow out 23, even though he borrowed out 12,600. Now, what that means is that for the fourth year of premium, right here, he has no 401k money left to use, okay? So he's got to borrow out $22,600 from his policy, okay? His loan balance on his policy is $40,000. And even by borrowing out the $22,000, he still has $20,000 of cash available. Okay. And so for the 5th year, he has to pay one more $20,000 policy premium. Okay. He has no money from his 401k, but what does he have? He does have the $20,000 of loan money in his policy. So he's going to borrow out right here. And his policy premium, do you see it drops from $20,000 to $8,000? Okay. So he's going to borrow out $8,000 as well as the $2,600. Okay. His loan balance, okay, goes to $42,000. And when he gave them this $8,000 right here for his policy premium, it's still left him with $27,000 of cash. Okay. Now he is just keeping his money in motion. Now, yes, he borrowed the $50,000 out of his 401k. He's now repaid the entire $50,000 to his 401k. So he's restored that. He has $27,000 of additional cash in his policy. And all he's required to pay for the rest of the policy is $8,000. Okay. At this point in time, he can start another $20,000 a year policy and do the same thing, even though he is 62 years of age. Or he can start it on somebody else. But what he did by using the $50,000 from his 401ks, he got the interest back that he paid to the 401k. He got to borrow his money out from his policy. He has a guaranteed death benefit, and his money that he put into the policy continued to grow every year tax-free. Okay. So whether you have a 401k, it might be a great time to use it and take money out, especially because you don't have the 10% penalty if you withdraw it. It also is a great time to maybe borrow the money out of your 401k, because this way you get to spread the taxes. I'm sorry. If you withdraw your money, you get to spread out the taxes that's owed to it over 3 years. If you pay the money back to the 401k, in some instances, depending on how long it takes you, you also can avoid the taxation. It's treated almost as borrowing it. So what we would really like to do is show you that even here, and I'm going to go back right here in this life insurance policy, if he had done the same thing, okay, and he actually kept paying $750 a month, he didn't even drop it after 4 years or 5 years, but he kept paying it. In the 35th year, 57th month, he has $438 of guaranteed cash and $1.2 million of death benefit. Okay. And we really want you guys to understand that with your life insurance policy, you get the benefit of having your money grow every single year, of being able to take that money and use it to pay down debt, to pay for bills, property taxes, your regular taxes, you name it. But if we don't start changing our mind shift from just doing what everybody else is doing, following the herd, right? And just keep dumping money into our 401k, we're never going to have complete control of our money. Okay? So remember just the fact of over 35-year period, what he created. He created wealth and he created a legacy. And he created the ability to be able to use that money whenever he needed, as well as pay it back, and it's not taxed. The growth on that money, like your 401k, it's not taxed. Okay? In a life insurance policy, it's not taxed. Yes, it's after tax dollars, But I'd rather be putting my money into this program and being able to take my money out and use it instead of parking it somewhere and having to wait 10, 20, 30, 35, 40 years to use it. So with that, that's all I have for you guys. I'm going to open it up for questions right now, and I think I can unmute everybody as well. So let me just open up the question first. We are with Emeritus and our policies, but they're direct recognition companies. So when we take out a loan, our money stops compounding correctly. Correct? Yes and no. Tammy, I would tell you that direct recognition companies, they can not pay dividends on the actual loan balance. So it's the dividend that you are not necessarily receiving on a loan balance. Most direct recognition companies will have a scale of what happens with a loan balance of what they pay, as well as a dividend scale of if there's no loans on that. There are some direct recognition companies that actually I would tell you reach out and we can talk to you about that actually allow you a third party to borrow. It's a different conversation to have today, but really what it does is it allows you to still be able to borrow money and have that dividend, but they're not all that way, the direct recognition companies. But you are correct, it does stop the dividend being paid on the loan balance. Yes, you could actually offer this to employees instead of a 401k. I actually have a completely separate presentation that shows you how an employee can use it and you can use it. So yes, you can. I just went in with another agent and we offered this to several employees within a company instead of their 401k, especially if they're not matching. Oh, absolutely. We work with direct and non-direct recognition companies. So you can choose to, we work with both, but we're very clear on if it's a direct recognition. We want you to know that going in. So most of the time, most of the companies we are working with are non-direct. Any other questions? All right, then I thank you guys. Oh, let me see. Okay, I thank you guys for your questions and answers and your time. I hope you learned something. Please, if you have comments, feedback, anything like that, please email me. If you want any information I used in the slide or this presentation, would love to email it to you. We got another. No, the 11,600 is actually what the loan repayments were, and so it actually all they did was take out $750 from his check each month. And what he did was that was what he was contributing to his 401k. So he stopped that, and then he just took the 2,600 from a policy loan to make up that 11,600. So 11,600. So what he actually did was he just had them take it out of his paycheck because that's what he had been contributing to it. It actually benefited him in regards to the fact he was repaying a loan. So that $750 is, as well as the $2,600 he took to repay the loan each year, also wasn't income to him. It was a loan from the life insurance company. So he didn't have to come up with the 11,600. It was just what he had been contributing already to his 401k. Okay, direct recognition life insurance companies are insurance companies that actually, if you take a loan, a policy loan out, they do not pay dividends on the outstanding loan balance. A non-direct recognition company pays dividends whether it is on whether there is a loan or not. So whether you ever take a loan out or you loan every single month or every single year you do a loan, they pay on dividends irregardless of an outstanding loan balance. Right. Is he ever going to pay off his policy loans? Actually, with his financial GPS that our company offers for free, we actually design and show him how to pay off his policy loans as well. It's just too many columns in this whole scenario to show you. But I will say, I'm going to go back just a minute and show this. So if he had stopped and paid his loans, like if you look at the very, very end, he's at $57,000. Let me see if I can actually pull it up. Okay. So his loan balance, if you look at in year 5, before he ever starts another policy, his loan balance is $27,359. Okay. Now, if he had never paid off that loan balance and something had happened to him, he's 61 at the time, his death benefit at that point was right at around $700,000. So he would have lost the $27,359. Okay. And I'm just going to round up and call it an even $30,000. So he would have only passed around $670,000 of death benefit to his family. So even if he didn't pay off the policy loan, the insurance company restores the loan basically by the death benefit if something happens. But we do actually create a column to show you how to pay off your policy loans so that it's not just this accumulating balance. Okay. All right. So I got one more question. The question is, do you ever use the cash value as collateral for a line of credit to get a lower loan interest rate and provide a revolving line for business or personal use? We actually can show you how to do that. So yes, you can do that. Sometimes we show you how to create it as a loan to your business as a revolving line of credit. I actually have been able to use it as well to say this is all I own is a life insurance policy. But we can walk you through how to do that and how to actually use your policy to show there's actually cash value or collateral for a line of credit. And we actually can show you how to use your line of credit even with your life insurance policy as well. Great question. So he did not stop contributing to his 401. He did and he didn't. He was contributing $750 a month to his 401k. And so that $750 right here, he just used to pay off the loan on his 401k. Because what he got was death benefit greater than what he put in, and he got cash to use. So what they did is, instead, he was not contributing to his 401k anymore. They were taking out the money from his paycheck, $750 a month, to repay his loan. So it's a non-contribution. It's a loan repayment to his 401k. So that is, and then the $2,600 difference came out of a policy loan. And typically what he would do is just give them that $2,600. So all they were taking out was the $750 a month at the beginning of the year. All right. Any other questions? Okay. Well, I thank you all for joining. If you need any information, you can go to Living Wealth's website. You can email me directly, give me a call. If there's anything you want me to review or go over with you directly, just reach out and let me know. Thank you guys all so much for your time. Appreciate it.